Към разговора в тази част на предаването, агенция Scope Ratings намали кредитните рейтинги на Украйна в чуждестранна валута, след като миналата седмица Киев обяви, че ще поиска отлагане от 2 години на някои плащания по външните дългове. Scope постави рейтинга на страната под наблюдение за евентуална промяна, като посоката й ще зависи от развитието на войната, преговорите с кредиторите и финансовите показатели на Украйна. Междувременно агенцията изнесе и новата си прогноза за глобалния икономически растеж, като вече очаква той да се забави до 3,1% през тази година. Повече по тези теми ще научим от Денис Шен, директор суверенни рейтинги в Scope Ratings. Денис Шен, директор Sovereign Ratings at Scope Ratings and lead author of the Sovereign Mid-Year Outlook of Scope Ratings, is joining us now to comment on the latest update of Ukraine's rating and global economic forecasts. Hello, Denis. Thank you for being with us.
Good day.
What is Scope's forecast for the global and major economies' growth?
Many thanks, Veronika. We have recently downgraded our global economic forecasts to 3.1% for this year for the globe. We cut this from 4.5% we had for 2022 world economic growth in entering 2022. And we have 3.6% global growth next year. That's not bad, but a sharp slowdown from 6.1% in 2021. The global economy, as well as that for the major individual economies and regions, the Euro area, the US, UK, Japan, we still see remaining in positive growth for the annual average this year and next year. But we enter this year, importantly, with a skew to risks for our economic outlook firmly to the downside, having indicated severe downside risks such as higher inflation and higher interest rates, the potential for Russian aggression against the Ukraine, emerging market risks as advanced economies, central banks tighten, new COVID variants, corrections of bubbly financial asset markets. Those risks we talked about late last year, many of them have crystallized and brought this recent downgrade of our economic projections. But the same economic risks, high inflation, further central bank tightening, China's zero COVID policy still remain dangers. The uncertainty around Russian gas to Europe before this winter is a further problem that's arisen for the economic growth outlook for Europe. This includes the risk of technical recessions.
What is the latest forecast for Bulgaria's economy according to Scope's outlook?
We have Bulgaria to grow 1.8% this year and inflation to surpass 11% on average for the year. We have growth next year of 3.5% for Bulgaria. Importantly, the halting of Russian gas does raise a significant concern, obviously, of energy shortages, especially with the low level of stored gas levels. The possibility, at least, of early elections after the no confidence vote creates political uncertainty, which hurts the recovery and could affect the timetable for acceding to the Euro area.
How is inflation affecting the debt ratios and the credit ratings?
High inflation, Veronika, can maybe counterintuitively be positive for sovereign credit ratings in the short term through trimming debt ratios. Many governments that we review are currently, in fact, seeing declining debt trajectories, even Greece and Italy, because of the very high inflation. Inflation has been, as well, one of the main channels to cutting debt ratios over past economic history. Sometimes inflation has been the only solution to a debt sustainability problem. But high inflation is not a vaccine and can damage real economic growth and growingly constrain central banks and their monetary space. In the case, their price stability mandates become compromised from, so to speak, overly persistent inflation. Because of this, on balance, persistent inflation, should it restrict lender of last resort functions of a central bank and the central bank's ability to intervene when markets fail, that becomes negative for credit ratings the longer inflation lasts.
Denis, what are your forecasts for inflation over coming quarters after central banks took decisive steps to tighten monetary policy?
The central bank actions to reduce inflation historically frequently require 2 to 3 years to translate really to the real economy and inflation. So the raising of rates is gradual as far as its effect on the speed of price rises. But we believe inflation forecasts of central banks will be revised further up for 2022, for 2023, for 2024 from the current central bank forecasts. That even acknowledging, given how high inflation is currently, nearly 9% year on year in the euro area, nearly 17% for Bulgaria, that there is obviously more scope for inflation to mean revert medium-term downward rather than to increase even more. Inflation ought to peak over the coming quarters across many economies, but in Europe, the surge of gas prices recently and the fairly significant probability of an energy crisis probably mean there's further upside risk for inflation, at least near term.
On a slightly different topic, Scope Ratings has downgraded Ukraine's foreign currency ratings to single C from triple C and placed the ratings under review for a developing outcome. What are the rating drivers behind this decision, Denis?
Thank you. This rating announcement of Ukraine Friday reflected, firstly, and probably most importantly, the consent solicitation of the Ukrainian government for the prudent restructuring of the Eurobond debt and GDP-linked securities. The request is to postpone payments on Eurobond debt between the 1st of August 2022 and the 1st of August 2024, a 2-year period. The government plans or hopes to save through July 2024 around $5 billion, which is about 1 month's financing gap, but nonetheless a significant sum. But such restructuring of debt is likely to be classified under our sovereign rating methodology as a distressed debt restructuring, a credit event. Secondly, our downgrade Friday to single C, which is only 1 level above default, also reflected a degree of further weakening of Ukraine's external sector due to Russia's unjustified war against Ukraine. For example, declining levels of foreign currency reserves to just above $19 billion by June. That's nearly cut in half.
Will Ukraine's creditors agree to restructure Ukraine's debt or to the debt service suspension?
That's a good question. And there have been positive signals of creditor support for Ukraine. More than that, for the kind of similar 2-year debt service suspension solicitation from the state-owned oil and gas company, Naftagaz. As an example, after Naftagaz defaulted, it was unable to achieve adequate creditor support so far behind a $500+ million debt service postponement. There is significant international commitment to assisting Ukraine. Recognizing this, and we do have early indications of explicit backing for the sovereign's debt restructuring from a group of the largest debt holders of Ukraine, from BlackRock, Fidelity to AMIA Capital. However, it does remain unclear the full extent at this stage of support from creditors for restructuring terms, and that clarity may need to await this period until the 10th of August, by which point there should be further information on how Eurobond holders are voting and responding. Importantly, a group of governments of the G7 has agreed to furthermore suspend a segment of Ukraine's bilateral official debt payments from the 1st of August 2022 until at least the end of 2023, which does send furthermore a strong signal.
And from this perspective, what is the probability of a default of Ukraine?
Aside from technical default risk near term, due to the debt service suspension negotiation, Ukraine faces significant debt sustainability challenges longer run. That's quite clear at this stage. I will say that given significant international goodwill presently for the Ukraine, there is likelihood of longer run debt forgiveness to address possible solvency challenges of the sovereign because of the war. This could involve forgiveness of official sector loans, such as that of the IMF, the World Bank, but it could certainly as well involve long-run write-downs of Eurobond debt, which is a further credit event. Under the scenario, such actions help Ukraine to achieve a more sustainable future and stronger recovery, which is our vision and hope in the end.